Today we're going to be talking about identifying your strike zones and median price. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. It's Friday, end of the week. We've had some fantastic opportunities this week. Again, working from the high and the low, keeping it simple, sticking to the timing rules, sticking to some very tight windows of opportunity, not only to increase the likelihood of us having profitable trades, but ideally also to keep us out of getting caught into poor quality setups or spending too much time at the screen, getting bored, taking random trades, getting caught into stuff that then distracts us from our primary goal of growing our trading business. Sticking to the simple rules that will work over time, that are consistent, that you can duplicate, that you can identify high possibility asymmetrical risk reward trade setups. We're going to review yesterday's trades. We're going to talk about specifically a couple of trades that I took, and we're also today going to talk about, as we head into this session, I'm going to go over what I look for and where my high probability areas for trade setups are going to be, if there indeed may not be one right off the start of the session, but if the market moves for a stop hunt up or down, where my strike zones can be, and if it moves up, if I'm looking for a sell setup, if it moves down, am I looking for a buy setup, or is it going to be a trending day? So let's get right into it. Again, I'm going to review a lot of the same steps every time, just to pound in the basics, but also if this is the first time you've come to the channel, it's the same process. You don't need to start over. We're going to just hammer home on some basic concepts about where the smart money works and how to approach the market to identify those areas. And again, just before we get into that, just want to say thanks. A ton of great feedback. Thanks for hitting the notifications button and the like button. That helps the YouTube algorithm generate more information for people who are serious about trading and want to succeed in this market. We're going to answer some other questions that have come up, but let's get right into this. 15-minute charts. We're looking for the high and the low of the day. That could be the high of the session or the low of the session. It's the same thing. High of the week, low of the week, ultimately are still going to be highs of sessions and lows of sessions. But essentially, when we start the day off, even into the rollover, just prior to the market opening, we will usually have a pin high, pin low somewhere in that, whether it's that couple hours before the market opens, whether it's from the US session into the rollover. And we're going to go over the charts and go through some specific examples from Monday forward of identifying our 50 pip box. So we should be able to target highs and lows that then we can establish that our box might be between 50 and 0. If those are the numbers, I'm just randomly selecting these. But that area in the middle, as the market's trading inside prior to the open, is what we'll call median price. So I really want you to identify the concept of not worrying about trying to guess which way we're going to go, waiting for the market. If this is the danger zone, getting caught inside, possibly. Now again, there may be opportunities where the market's worked into 3 pushes, and as we head into the open, we may be already in a trade opportunity. But we're talking about the average trading day. We've got a high and a low. We could be in a 50 pip box, and on some of the pound crosses heading into the London session, they may only be in a 25 pip box. But for gold specifically, pound Aussie, some of the more volatile pairs will usually have at least a high and a low that gives us, between the numbers, a 50 pip box. It might only be 30 pips from high to low, but we've got our number levels marked off, and we have an area that we can now call median price. So again, just to reinforce that most stop hunts are going to be 25 to 50 pips outside of this range. So if the market starts to move up towards this range into that first hour, or in that last hour, first hour, okay, and our high of the day scenario is up here, okay, again remembering the fundamental principles They are going to go after the money. They're going to hit stops. But if they go up first, chances are we are going to be looking for a sell high setup. Okay? Okay? They're going after the stops. Now again, the timing window is what's important. We'll review this again. 8 to 11 p.m., 2 to 5 a.m., 8 to 11 a.m. for Asia, London, New York Eastern Standard Time. So again, the question regarding timings comes up. Some people have answered that question in the box, but regardless of how your chart candles are timed in terms of GMT or New York time or your local time, whatever that may be, Google what time it is where you're at in relation to, if I'm in Perth, I'll Google New York time in Perth, so I can then take and look at my chart right then and there and say, well, okay, if it's right now, if it's 12 midnight in New York, well, in 3 hours, that's going to be the first candle for my New York or my Europe London Open. 2 a.m., 3 p.m. in Perth because of daylight savings. But that's my windows. I just calibrated accordingly. 8 to 11 p.m. for Asia, okay, which for me is 9 to 12 a.m. in Perth, 9 to 12 p.m. Sorry, 9 a.m. to 12 p.m. and 9 p.m. to midnight in Perth for New York session. Now again, I usually focus on that first couple of hours. The only session that I would usually possibly be there for a third hour is for London. Typically I'm done. I want to be done in that first couple of hours or in that trade and following it through to its process. So, but our round numbers, okay, this could be a quarter level, and quarter levels for medium price. Medium price might be double zeros, it might be 25. I'm just using this as an example. But when the market, if the market is in here, this is a 50-50 area, okay? 50-50, and if you've been trading this, and oftentimes we don't even have an opportunity to think about it unless they go sideways in here for an hour. Typically they will usually already be breaking a high or breaking a low. Yesterday on the pound crosses, typical example, they broke the highs in the last few hours of the Asian session, and that first bar heading into the Europe London 12 candle window was an open drive candle. They moved straight down, but medium price allows us to understand 25 to 50 pips outside of that area. So if you had a rubber ball and you bounced it up, aside from a trend day, that ball goes up, we want to be selling high for the move back down. Now in some cases, the market may give a sell signal right off the bat, come down 25 pips, and come back into that trade before it comes back down and rolls over. There's lots of different scenarios, but again, we've talked about when you're selling high, okay, selling high, it's a 1 bar stop, or buying low, it's a 1 bar stop. I'll make that a bull candle. Could be a bear candle, but it doesn't matter. If our strike zones are down underneath or at this level, or up top at this level, again, they may go 25 pips and it may keep going. So what that means is we're not just blindly jumping in at the high or at the low. Typically, a session may extend another 25 pips above the range that it's just come out of. So if this is our trading range, that may be, they may go up to 50 and stop there, but they may extend that another 25 pips before it exhausts for the sell high signal. How do we know that? Where are we in the timing window? If this is the first hour and they're going higher, chances are that the London equities hour or the New York equities hour may put the high of the day in place. So again, we talk about as the day unfolds, if they go up, okay, that means that so far Asia is now the low of the day. But if they put a peak formation in place, they're either going to come back down to the low of Asia, or they're going to come down in 3 pushes and go back in New York and possibly lock in the high of the day in the New York session. Now that is different, of course, than trading sideways in 2 sessions, maybe even into New York for a squeeze, for a trend breakout, or a breakout and a pullback in that Europe London 12 candle window for a trend trade. Okay, that's different than median price and then bang to the high or bang to the low in that first hour. So again, we're looking for the stop hunt to stretch us apart outside of that median price range because we want to be selling high. Okay, some traders want to trade that move up. You can do that, but if it's a burst of candle, okay, we want to wait until they're done with the stop hunt. Some traders might get caught in what they perceive as the stop hunt. The market may not even get there. They might pull it back and roll over. So you want to wait until the market has confirmed to us with its price action, even though it's going up, if it's going to extend out, or if they're jamming it in, or if indeed they might consolidate. They could consolidate at the high for a continuation move. So again, what are we looking for? We're looking for evidence of a stop hunt. We want to see the stop hunt, the pins through the low, or moving down and giving us a double bottom formation, locking in that low after they've cleared the stops, or up top with that extended M formation up top. But again, that's after they've hit the stops. Reinforcing 25 to 50 pips, okay, usually extending out to round numbers. So if the market moves 50 pips, the high of the day is here, they may extend it up to 75, and for the next couple of hours trap volume up there before coming back down in a fast stop hunt pattern. So if they extend it out in that first hour and they stay up there in London, chances are now we're in a 3-push pattern for a squeeze, for a sell-off down through the lows. Now we saw an example on the pound where they caught traders counter trending, they brought it up another 25 pips. So again, reinforcing a squeeze will keep taking traders into that extreme without going further before reversing, as opposed to pulling back, trapping traders in the wrong direction, and then continuing the move. So strike zones are going to usually be 25 pips above median price or below median price. Again, we'll look at some specific examples on the charts prior to each session opening. Where's the high, where's the low, and how to identify those main target areas. Round numbers, okay, and again, understanding that those quarter levels can be used to trap volume up above or down below a round number or 50 pip box. And we're looking for engulfments and pin hammers. If there's a pin through a high or through a low, that pretty much has got my attention right off the bat, and depending on how that price structure and what time it is, how it evolves in that next couple of candles will confirm if I'm entering in or at the numbers. Again, if we're at round numbers, double zeros and 50s specifically, we'll see these markets close there. But if they've extended through there and they've pinned up to a quarter level or down to a quarter level, now I'll be looking for them to possibly be squeezing above that quarter level for the reversal trade back in the other direction. Okay, 1-bar stops, we talked about those yesterday. And again, the number one thing is I'm waiting for them to do the stop hunt. So we saw a 50 pip move to the previous day's high on gold yesterday. The market basically stopped right there, pinned up through a bear pin hammer, and that was the high of the entire day yesterday. It hit the previous day's high in the 50 pip stop hunt. After 3 pushes into the low in the Asian session, we're going to review that to understand how that strike zone, as they came into that 12 candle window, they layered on top of the strike zone from Asia and continued that move right off the open in that 3rd candle of the equity the opening 12 candle window. So keep it simple, 15-minute charts, high and low of the day. Now yesterday we did talk a bit more about shorter time frames, and I addressed that I will only look at those shorter time frames at the extreme highs or at the extreme lows, but with the understanding that typically you're going to spend a minimum of 30 minutes up near that area, you get at or below those areas, or depending on if you're at the bottom or the top, because it takes 2 candles to reverse, so you're looking at 30 minutes of a structure evolving on a shorter time frame. So just really specific about not trying to trade on the shorter time frames unless I'm out here. So I hope that makes sense. I want to be out spread apart further away so that my risk as I'm trading up here And again, we're not counter trending a trend. We're talking about a stop hunt and then the market locking in a high or locking in a low, and our median price is going to be the minimum usually that market will move back to. So we're looking at, the further we get apart, now we're talking about mean reversion after they've cleared the stops, and they're going back after the traders that are in the money that took the trade on the other side. So I hope that makes sense, but it's always about the money. That's it, nothing else. It's about the money. Make sure that most people either lose or don't make anything. So that's why we talk about clearing the money, taking profits. Anytime there's a consolidation near a high or low, I'm at break even or taking money off the table, especially after we've been in the trade for a certain amount of time, and if there's been a stop hunt. So keep it simple, traders. Let's look at the charts from yesterday. Again, thank you for a ton of great feedback. Hopefully we're getting through a lot of those questions. But the most important thing is to be understanding the concepts of working from the outside, not getting caught in poor quality trade setups. If you're in the move coming out of the median price to the high or to the low, no problem. That's a great opportunity. If it's working, keep trading it. But again, knowing where these markets can fail and possibly understanding that market can still extend out before it finally locks in a high or a low. We've had some great opportunities yesterday on the pound Oz. Pound end of Asian session, they locked in a high, open drive candle right off the bat, a fast move to the previous day's low. You're done in an hour, a couple hours. Even if you took 25 and got back in for a second 25, there's 50 pips. Zero stress trading. So let's keep it simple, traders. End the week on a very strong note. Do everything right today. Stay focused. Manage your downside. Look for the best setups, the ones that you can reproduce next week, next month. Keep growing your account, even if it's slow. Keep growing it, get your confidence up. Focus on the highest, best trade setups. Yesterday I took 4 trades. That's over the 3 sessions, so basically 1 per session. I didn't stay up that late for the US, but my point is, I pretty much will only look for 1 trade. I'm looking for 1 or 2 really good trade setups, and sometimes I'll take a trade, I'll take something off the table, then I'll get back into the market. So end the week on a strong note, but don't be chasing trades all over the place. Focus on 1 or 2 high quality setups, ones that you can again identify next week at the high or at the low. Keep it simple.
Good day, traders. Stacey Burke from Stacey Burke Trading, just continuing our discussion on identifying strike zones and our median price area. Just before we do, just reviewing our daily gold chart, we talked about the possibility of a big move eventuating over the next few days, possibly on gold. We'll see what happens. We had a large move down on Monday, Tuesday, coming from that peak formation at the beginning of the month. And obviously, couple of days of consolidation. We had Monday, Tuesday, then Wednesday, Thursday, inside bar Wednesday, and a narrow range, pretty much an inside bar on Thursday, yesterday. This market is breaking that as we speak, but there may be weak follow-through for an explosive move back up, possibly. We'll have to see. We could be in for a large ranging day today. It may eventually move back down for another push lower. We do have a breakout trade from the beginning of June with stops probably somewhere in this level, and we'll take a look and see what happens. So we'll have to see how this market trades today, but obviously a lot of momentum Monday, Tuesday, and then that tight consolidation, possibly a bit of follow through today. We'll have to see what happens, but that big explosive move went into consolidation. We'll watch and see. So continuing our discussion, we'll go back to the beginning of the week and just look at each session, how we can identify the strike zones and high and low median price heading into the session. And each session, I mean, some are very clearly can be obvious. Obviously there's highs and lows as we head into each session. So as we head into, we talked about this on Monday, we saw the market take out the low in the rollover, 3 pushes down. We have a pin down below at the opening of the day. So again, we want to look at the extremes as the potential target areas. So we have a number box at 75 on the low side, and we have, as the market comes up and hits the high, obviously the high is at 50. Now the market pinned up into 50 before pulling back. Our median price obviously was spread over the 75 pip box, but in this particular case the market layered on 0, so we could extrapolate between high and low. We have the high at 50 and the low double 0, so our median price therefore is 25. And so as we head into the 12 candle window, as we could see the 3 bull pin hammers, bull candles layering on 25, and then the stop hunt to the high. So again, the market went to the high, it hit the stops, gave us a doji. Some traders shorted the break of the 15-minute candle. Other traders, again, this is an example of possibly where traders can use smaller time frames for an entry after they've hit the stops. So the market has hit stops. We can identify that entry possibly on a shorter time frame, or use our 1-bar stop. As I stated earlier in the other videos, in the majority of cases, your entry will be very similar to the 15-minute entry regardless. So you have an entry there, the market comes back down, doesn't quite go to the low of the day, but as we can see, it's gone to the low of our 50 pip box. We had a strike zone high and a strike zone low. As the market gets down close and does not penetrate through, again, an example of where traders might be looking to take profits at the numbers plus the spread, but important to identify that the market had layered on top of zeros. This obviously still could be potentially a target for later in the day or the session, but you're up 40 pips, 30 to 40 pips in this area, you're done. So talk again about zero stress trading. You want to be able to take a trade. This is your target area. Again, in Asia especially, you may not get the 50 pips, or if the market closes without going through a level, again, we can see how fast they come back and stopping out traders at or near break even before going into consolidation and layering on median price. So we got our 50 pip box, 50s and double zeros. They're layering on top. We're expecting stop hunt to the high of the day. We get a pin to the high and a 1, 2, 3 down. Some traders are in early. They've got a stop above there. If, again, an example of where they may be stopped out at break even, or if they've not taken anything off, the market comes back into our equities hour before giving us our second leg. Again, the second mouse gets the cheese. Timings, why timings are so important. We get our middle structures in place now. We have an M formation. So again, market's done a stop hunt in that first leg down on traders that were long at median price. So again, the pin's gone below the middle of that box, stopping out traders who were all trapped in that upper quarter. Pin, stop hunt, comes back, stop hunts into traders at break even, puts heat on traders that are in early before rolling over, engulfing, bear pin hammer for the 50 pip plus move down. But again, if we look at our session, this one's pretty straightforward. We have a high and a low, easy to identify our strike zones and our median price. As we head into the US session, again, we have a low in place. So again, our lower box would be the quarter level at 25. The middle of our box, median price, is 50. And we have 25 plus pips as the market pulls back and gives us a redrawn high. So we don't have a high to reference. We have a breakout low that's at that quarter level, 75, but the market comes up 1, 2, 3 and goes into consolidation. We now have a redrawn high, especially once we get the engulfment on the first candle of that 12 candle US session. So if we just draw that little engulfment. So again, then we have a high now. Our strike zone is that upper quarter or the high of this structure, and then we have our low strike zone, that quarter, a 50 pip box. The market comes up 1, 2, 3 into the quarter level before rolling over. So again, a 50 pip box. Even though it's gone higher, the important concept to grasp here is again a 50 pip box. A 50 pip box for selling high and buying low. So if you see the market, well, it's gone higher than 50, whatever. But it's the concept I want you to grasp of a 50 pip box, and we're selling high in a downtrend rather than chasing the move. We want to wait for that 1, 2, 3, the stop hunt back into the first mouse, for an entry somewhere up at or near numbers. The market gave you 1 hour at that quarter level, 1 hour. So again, first hour, stop hunt, trap, and a stop hunt down into traders that are long, and then a trap, taking traders back up long into the equities hour before rolling over at the top of our 50 pip box. So again, we don't want to get caught in the middle. If we can help it, we want to sell high or buy low if you're buying. We head into our next day. Again, we have the low of the day broken right off the bat as the market opens, but we have a high structure and a low of the day structure from the previous session, from the previous day. So as the market is about to open, we have median price at 50. Median price, we have double zeros. This is a 100 pip box. Okay, 100 pip box. Basically, the market is traded inside of. Our 50 pip box, obviously, if we lower this down, the market is pinned below the quarter and above the 50. So we have a 50 pip box between 75 and 25, but our low of the day structure obviously takes precedent for double zeros. And again, a full range expansion of that, just doing the math on double zeros, would offer traders obviously up to 75 pips possibly of tradable opportunity on the downside. And so again, engulfment, just as the market opens, as subtle as that may seem, we have a market that gives us a little M structure at the high of our box. They dropped it down back into median price with another engulfment. So you're selling off of median price at the high of a 50 pip box, off of 50 for a move back down. But again, the strike zone, 100 pip box, they narrowed it down into 50 pips. After a strong down move, the market breaks down, pulls back into the 50, into the round numbers, sideways, engulfment, pin hammer right off the open candle for a 100 pip move down. So we head into the next session. We have our low of Asia. We have a lower high in Asia that is broken. The market pins through and continues to rise. So we have a short trade in place. This is a stop hunt back into the traders that are short from the Asian session. The pin goes right up into traders who would be at break even, right in our first two candles. They engulf it on the third candle, and again, just reinforcing. People ask about using multiple time frames. If you understand the timings window, 3 bars, this is a bear pin hammer now on a 1 hour chart. As soon as they close that fourth candle, this is a bear pin hammer. That pin is a stop hunt back up into the short traders in a downward trending market. Day 1, day 2. Day 2 makes new lows. We're in a downward template. Okay, this isn't a peak formation. This is a stop hunt high for a continuation, and again, coming back to, if traders are holding on to this, the possibility of a measured move for a full or second full expansion of this trading range. I typically will hold on to one position for a certain profit target, but I will gladly re-enter into a trade if we're in a strongly moving market. We head into our US session. We have a pin high and a pin low. So again, identifying our structure, pin high, pin low, right off the bat, we have our 50 pip box. We're actually almost in a 100 pip box, but again, you see the opens and closes consolidate this inside of a quarter level, but our pins respect the 50s on both sides. So we have median price of double zero. The market opens at double zeros, pins up into traders who have shorted the market on the inside bar. The pin is high. They've stop hunted up for they move down, pull back, and continuation, extending our range. So median price was a selling area. Again, the market at this stage is obviously possibly in a blow-off or a range extension. We had 1 push, 2 pushes, 3 pushes down before the market pulled back and consolidated. Point being, though, the market's in a down move. If you're not in, we come to the 12 candle window, our bias is with that move until we have reason to believe otherwise. The stop hunt was up. 1 bar entry. If you're short on this trade, the market again came back into your trade before continuing down, but at this stage we're in a creeping trend. They're hard to hold on to. And again, the market after creeping trend ends itself by pulling back inside of the range. We do the same thing the next day. We look for our range high, range low. In the rollover, we have a pin high that's been set in the rollover. The market comes down 1, 2, 3, makes a new pin low. Then in the open of the Asian session, straight to the high with a pin, consolidation and doji. So again, we're working from the high and the low. We have a 50 pip box that extended 1/4 level above the double zeros. So we have double zeros. The first thing you got to be thinking is stop hunt into the upper quarter. Engulfment, sideways, bear pin hammer, 50 pip move back down. We want to sell high or buy low. The market goes sideways in the gap time. We have a 50 pip box. They trap volume down in the lower quarter below the 50 pip box. They engulf it just prior to the 12 candle window. 1, 2, 3, snowplow, pin high, and then the break of the second candle high for the stop hunt back up towards the high of the day. And you'll notice the high of the day, they extended up 25 pips up to the round numbers, up to 50. An example again of where traders, if they've entered in on shorter time frames, the market comes back 50 pips, but on the 15-minute, basically a 25 pip stop hunt back into the trend before hitting the high into the high one more time and engulfing. And then again, the traders getting a 25 pip move through the low of the middle structure. So again, we talked about 2 pushes and it's still in a 25 pip box, taking money off the table. We're in the gap time. Second leg does not follow through. Close the trade because they're possibly going to come back up. And you've got 25 pips, lock it in, take the money, don't get stopped out at break even. Again, next session, we have a pin high, and this is a beautiful thing, and a pin low. They've opened up the trading range. They've spread it apart. So we have a 75 pip box. So median price, obviously, the strongest as they come up and head into the open of this session. Our median price becomes the quarter level. The middle of this last consolidation is in the quarter level. But we have a pin high, pin low that's 75 pips apart. Again, we want to be selling up top or buying down low. The market pins up to the high, engulfs. We talked about this the other day. Once it's down low, near the bottom, we have a swing low. The market taps that. You need to be going to break even. They come right back, hit the high one more time in the equities hour. Last candle closes as a bear pin hammer. Again, hard to sit through, but when you're right, sometimes the market, especially if it's a level 3 sort of area, where 1 push, 2 pushes, 1, 2, 3, pinning the high, they consolidate, make you sweat it out before dropping it finally away back down to the low of the previous session and then closing out into the next day. So heading into the new day, we obviously have high of the day, low of the day. But each session again, right before the market opens, the same as Wednesday, we had a pin high and we had the market come down and give us a pin low before pulling back. And again, the market comes up right at the open. 1, 2, 3 pins the high to the quarter level. Our median price is double zeros. They pull it back to the quarter level before pushing up again, a second time into the high before going into consolidation and rolling over to hit the low of the day. And immediately they hit the low, pull it back, they take out the middle structure. Again, trapping volume above the double zeros before rolling over, hitting the stops, pulling back. So again, point clarifying, 50 pip box, we want to sell high or buy low. The market comes back, and in this particular case comes through the median price, giving it a little inside bar for a continuation measured move. Inside bar after the stop hunt. So right as our 12 candle window opens, we get a double inside bar after the stop hunt, after the 3 bar push through the high of the day. So we have a particular situation where it's a measured move. 1, 2, 3, inside bar, range extension, double inside bar. This is an explosive move back to the high of the previous day. So, example of where the market moves strongly back to the previous high of the day. We may not be in this trade on the double inside bar. The market pins the high, pulls back, goes up a second time, pulls back, goes up a third time, and finally gives us an engulfment of a tiny structure after the middle pin bar. So again, a pin bar up high usually is a trap. The market goes into consolidation before breaking down, not quite 50 pips, but 25 locked in for sure. The market pulls back in one push, two pushes, 1, 2, 3, and you'll notice again as our US session starts, we have a high and we have a low. Now again, this high becomes lower highs because they dropped it down 1, 2, 3, and then went up 1, 2, 3 at the open and pinned into the high. One push, two push, three pushes, and on the third push, we get one push, two push, three pushes. My friend Malik will love the 33 trade and the little bar, the little inside bar for the 50 pip move back down to the low of the day. You're underneath a peak formation structure from London. So there's a peak formation high. We do not counter trend the peak formation. They pushed 3 times on the third level, third push in the US session for the stop hunt back down to the low of the day. Now we talked about the daily gold chart. We've just had a stop hunt. So yesterday, just to go back over, we had an inside bar on Wednesday. They hit the stops of triggering inside bar traders long before coming back today and hitting stops on the low side of yesterday anyways, but not the inside bar, but they would have possibly moved their stops up. This pin bar could still end up being a trap as we head into our 12 candle window for 3 pushes and a retest back down to the low of our pin bar structure. If we get this type of scenario today, we could see a very large move to the downside. Again, just not predicting, just hypothesizing. If we see this market possibly roll over and retest the low of this pin, we could be in for a very large US session. But we'll watch and see what happens. If anything else happens, the market could just go about having a normal trading day. We'll wait and see. So looking at our pound Aussie yesterday, we again just drawing our structural highs and lows. We're looking for any areas where the last trades may have occurred as we head into Asia. Again, our rollover candles may be different in this middle 1 or 2 bars, depending on your data provider. But we have short traders in the market. In Asia, they come up, they hit those trades, they engulf it, they stop hunt down to the low of the Asian session pin bar. Again, we redraw our highs and lows. We see again the engulfment at the high after a stop hunt on traders who were short. So again, asking yourself, where's the most recent profitable trade? They've gone up, gotten that trader at break even. When we have a peak formation in place, so we've identified a 50 pip box. They went up high in the 50 pip box to double zeros. They've engulfed it. As we head into our next 12 candle window, we have the first candle with a pin up top into the engulfment. This is a 1 bar stop for an entry right off the open of the session. And we have 2 areas that can potentially slow this trade down. 3 actually. We have the low of the initial low of the day from the swing of the US session. We have round numbers at 50, where we see the market go into consolidation after it clears the low of the Asian session and the low of the US session. But you'll also notice it pushes underneath, 1 push, 2 pushes, and we get an engulfment. So this is an example of if you're in the money and you want to take money off, you can still get back into this trade. Engulfment pin hammer at the end of the 12 candle window for another 25 pip move down. Traders who were in at the beginning of the session were able to see that this market was possibly going to retest the previous day's low. And again, if we just back our charts up a little bit, going back, we come back to, and we'll just zoom in on this if we can. No, we can't. So, but low of the week, market extends that low of the week out, coming down lower. U.S. session, again, you see the pins. You can start to see this shows up right before each 12 candle window. We have a pin high, pin low. We're in a 25 pip box, so medium price in this particular case. Again, we're just trading with the trend, but we had 1 push, 2 pushes, 3 pushes against the down move after another breakout candle. So again, just paying attention, price action. Pins off a quarter level, trapping volume above the quarter for the continuation down through to the double zeros. We're in a 100 pip box. 50 was median price. They drop it down in the quarter level. They push against the trend in 3 pushes into the 12 candle window before engulfing and continuing that move down to the double zeros. Again, if we look at the British pound, we can see that as we headed into yesterday's session, we were up high for the week. We're at the high of the week, evidenced by this blue dotted line. Our blue line is hit. They pull it back. We're in a 25 pip box, which is normal for the pound in Asia. But again, we've got levels here where volume, again, paying attention to that quarter, that upper quarter. That upper quarter is gone into consolidation. We have all this area where this volume's trapped up top, and bang, 1 candle shifts away. So we head into our 12 candle window. The stop hunt is high into the top part of the box. They pull it back with an engulfment, a sideways bull candle underneath the previous day's high. A breakout candle, then a 1-2 bar breakout. So traders, pay attention to this. This little bull candle that pulls back into the breakout off the high. When it breaks that low, I'm in the market. I'm shorting a bull candle with my stop above this candle. And the psychology is that when they move this quickly, as they did, there's no way they should be coming back up here and even going to break even at this stage. Once this pin goes up and closes, I'm at break even, because once they're done up here, they should be pulling away. If they come back up here, they allow traders to get out of the market without a loss. Shorting the bull candle catches people, again, trading in the wrong direction. And again, the thesis behind understanding that is that this is a safe place for me to enter the market, because again, if they short this candle and I'm in the market, they're not going to come back and let these traders out of the market. Bang, they go through the low of the box. They extend that out in a 1, 2, 3. They come back into traders chasing the move, sideways, inside bar, and the continuation for a 50 pip plus move down through to the low of the U.S. session, 1, 2, 3 down. So again, an example of where they don't necessarily need to go all the way to the peak formation, but they got the traders who were long from the previous night's U.S. session, who possibly haven't taken money off the table. They just went up, worked the high, worked the high, worked the high, pulled away, pulled back, putting heat on traders who have shorted it late, catching traders going long before shifting down and hitting stops from the U.S. session. So again, identify your strike zone, your 50 pip or 25 pip highs and lows for areas to be selling high or buying low. And again, if the market is already in process and moving, we want to be trading in that direction when the market gives us that opportunity to again identify a 1 bar stop, whether it's an engulfment, whether it's a bull candle in a down trade, or a bear candle in a long trade. So keep it simple, traders. Again, end the week on a strong note. Do everything right. Have a great trading session, and may the market.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.